Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, tonight is an educational show, and we are going to be talking about options, which is possibly what we should have done a long time ago before you started crafting fairly fancy option structures against various indices like the top 40 and the S&P 500.
Yes, that's right. Look, what I've realized, and maybe silly of me not to think about this, but we do all these fancy option structures on the show with put spreads and call spreads and all these intricate things, and options are actually quite advanced derivatives, and especially when you start putting them together the way we have been doing on the show. But of course, we've never really gone to the basics and said, well, what are options, how do they work, and what are the real basic components of an option?
Yeah, so 101.
So this is an options 101 course in 15 minutes, effectively, detailing what the basics of an option are, how they work, and you know, to try and just at least elevate the level of understanding of those in the audience who possibly don't understand how options work.
Okay, so if we start with call options and put options, perhaps you can explain both.
Yeah, so a call option is effectively, it's an option to buy an asset at an agreed price at a future date. So there were two things there, at an agreed price and at a future date. So if you think about the options we've typically been trading on the show recently, these options expire in September this year with the closeout, which I think is the 15th of September, I think, or it's thereabouts anyway. And then at a specific price, we determine what that strike price is up front. Okay? So a call option is an option to buy an asset at an agreed price at a future date. Now, a put option is the opposite of that. It's an option to sell an asset at an agreed price at a future date. All right. Typically, if you were just going to buy options, if you were going to buy a call option, you would do that in the event that you're bullish, because you think price is going up.
Okay.
If you were going to buy a put option, you would do that because you feel that the market is going lower. In other words, the put gives you the option to sell an asset at a particular price once the market's already moved lower. I think it'll be a bit easier to explain it with diagrams. So I'm going to go through a diagram of a call option first of all, and then secondly we'll look at a put option and explain the different payoffs, and also from a perspective of you as the holder of an option versus the counterparty who's the writer of an option. So on this very simplistic graph I've got over here, this left axis is the profit and loss line, and then along the bottom here is your price line.
Okay.
So a call option typically has a payoff profile like this. All right, you have a strike price. So let's say, for example, you have a share here who's trading at whatever price. You go long of a call option with a strike price of 100 Rand for a future date. So we say we're happy to buy this XYZ share at 100 Rand at a future date. Come that future date, it doesn't matter what the share price is trading at, you have the option to buy that share at 100 Rand. Even if it's 200 Rand a share by then, you have the option to buy it for 100 Rand. Obviously, if the price is less than 100 Rand by then, you're not going to exercise the option, right? Now, in order to have that option available to you, you pay what is referred to as an option premium. And that shaded area over there now illustrates the option premium. So let's just assume for simple purposes that the premium you paid here is 5 Rand per share, right? So in other words, what that means is that you can see that your payoff on that call option is below it's effectively in a loss of minus 5 Rand at that point, up until the strike price of 100 Rand. And then if the share price rises from there, then your call option will start to make money from there on. Now, in order to actually recoup the cost of your premium, you need the price to rise by the amount of the premium effectively in order to get past. So in other words, in this case, it would be 105 Rand.
Okay. Because
because your strike price was 100 Rand, your option goes properly into the money after 105 Rand. And thereafter, it'll continue to make you money irrespective of what the price is. It'll continue to make money all the way up. So that's what we term a long call option position, and that's the payoff profile that you would receive if you bought a call option. Now, obviously, every transaction has two sides to it. You have a buyer of an option and a seller of an option. So the counterparty is the seller of the option in this case, or the writer of the option. Now, that dotted line there illustrates the payoff profile of a written call, where you're the writer of the option that's actually effectively sold that option to somebody else. You can see that your payoff there is a mirror image of that green line, which is effectively what a long call would look like. A short call is the opposite, all right? The short call earns you premium whilst the price is below 100 Rand in this case, you earn a premium of 5 Rand per share effectively. And if at the expiry point the price is below 100 Rand, then you're not going to exercise that option. Then the writer gets to keep the 5 Rand premium, and the person who bought that option loses the 5 Rand premium. If the price is beyond 105 Rand, as is this case here, then the writer of the option would start to really lose money, and the buyer of the option starts to make money. The terms in the money and out the money are very applicable to options, and you can see to the left-hand side of the 100 Rand strike price over there, we talk about that being out the money, and on the right-hand side there, to the right-hand side of 100 Rand per share, that is in the money.
Okay.
Right, so that's kind of basics on call options.
What about put options?
Right, so put options are now the opposite. Remember, a put is an option to sell an asset at a future date at an agreed price.
Yeah.
So your payoff profile on a long put position is like what I've shown you there with that red line and that red arrow. Again, we assume a strike price of 100 Rand over here. So if you had gone long of a put option, in other words, you've bought the right to sell this share at 100 Rand per share. If the price then starts to go lower, then your option moves in the money.
Yes.
If the price stays above 100 Rand, then your option is out the money.
Yeah.
Okay. And again, for simplicity, we assume a premium payment of 5 Rand per option here. So above 100 Rand, you've effectively lost that premium. Below 100 Rand, your option starts to make money, but actually only below 95 Rand in this case will you really start to make money on that put option, because that's where you've recovered the cost of your premium. Right. So that's a long put option position if you were buying a put option, expecting the price of an asset to go lower.
And if you're selling a put option?
Right, the seller of a put option has a payoff profile that looks like that dotted line over there. So above 100 Rand, effectively the seller of the option, or the writer of the option, gets to keep the premium, which in this case again is 5 Rand. And below 95 Rand, that option then goes in the money. And again, notice now, in the money on a put option is on the left-hand side, and out the money on a put option is to the right-hand side over there. And of course, if you get to your expiry point, and the share price in this case is above 100 Rand, you're not going to exercise that option. Then the writer of the option keeps the premium, and you as the person who bought that option, you lose that premium. But if your price starts to move below 100 Rand, and specifically below 95 Rand, well then there's obviously money that has to exchange hands in terms of the writer paying to the buyer of the put option.
Garth, I mean, this premium is theoretical, say 5 Rand, but it talks to the price and the pricing of options. So how do you actually arrive between yourself and the writer of the option what you're going to pay for it?
That's a good question. So there's 7 factors that determine the pricing of an option, and there's a model called the Black-Scholes model, which is actually what options pricing is all about. But effectively, it takes into account these 7 factors. So the first is the current stock price, and then the strike price after that. So the closer the current share price is to the strike price, the more expensive your option is likely to be, because the closer the price is right now to what your strike price is, the more probable it is that your option could end in the money. The next point is the type of option. Is it a call option or is it a put option? Obviously, that is very significant because it determines whether you have an option to buy the asset or an option to sell the asset. Then
because essentially you're betting against each other in this sense. Puts and calls.
To a certain extent, yes, and to a certain extent, no. It does become a bit grey, and I think I'll show on the next slide where you can be bullish or bearish when you trade both of these, so it makes it a little bit more confusing. But the fourth point there is the time until expiry. The further out that you are away from expiry, the more expensive an option is, because you have more time for that option to potentially move into the money. So your time value of an option is increased the further away from expiry it is. Then interest rates are a consideration. The higher the interest rates are, the higher the price of an option will be.
Okay.
All right. Then dividends are also taken into consideration with a stock option. If there are dividends due to be paid between now and the expiry time, then those dividends need to be taken into consideration. And then the last one is the implied volatility, and this is one of the more complicated terms. Volatility just refers to how volatile the share is, effectively. The more volatile a share, potentially then the more likely it is that that option could move into the money at some stage during the life of the option. So the higher the implied volatility, the higher the price of the option will be. The lower the implied volatility, the lower the price of the option will be.
Okay, now you talked about, if you're betting, essentially you're on either side of a call or a put. When are you bullish and when are you bearish? Because I'm getting a little bit hazy here, to be honest.
Yeah, so this is interesting because typically people think, okay, call option, that means bullish, and put option, that means bearish. But not necessarily. So what would you do with each of the different types of options if you had a view? If you're bullish, you would buy a call option, right? But if you are bearish, in other words, you think the market's going lower, you could also sell a call option, because then you could sell a call and effectively receive that premium and know that your option is probably going to expire worthless, and then you get to keep the premium on that call. So you could trade call options whether you're bullish or bearish, just depends on which way you want to trade them. And similarly with a put option, typically you would think about trading a put option if you're bearish. You would buy a put option if you're bearish, as it says in the table over there. But similarly, if you are bullish, you think the market's going up, you could also sell a put option. You sell short a put option because you don't believe that the market's going lower. You believe the market's going higher. So if you sell a put option, you get to keep the premium of that put option, and hopefully that option expires worthless.
And when we talk about you get to do this. You get to sell. Who is this theoretical you? Because there's got to be a counterparty, as you said, to the trade. So if Joe Soap here walks along and says, I want to trade options, who is selling me the options, or who am I selling the options to?
Well, typically there are market makers available that will price up options, and they will take the other side of your trade. It's a far more developed market overseas. So, the South African options market, unfortunately, has never really developed a lot in my years in the market. We do trade top 40 options here, and I can do it. I know who to talk to at the banks to get a price. But it's not easy. And it's not like there's just a price available on screen that I can trade against. So I would say for someone wanting to get their feet wet with options, possibly look at doing it overseas. Look at maybe trading something like S&P 500 options, where you can do it in very small lot sizes, and trade in small size in order to get to understand the cash flows of how the movements in price work with options. It's a lot easier to do it there than it is here, because our options market is not developed, unfortunately, in South Africa.
But is that easy enough in and of itself? So how would you go set up an account? IG is our sponsor, and they're a huge global brokerage. So, for example, you would use an IG account, set yourself up, and then can you trade options on the S&P 500 or any international market?
Yes, you can. So that's it. If you open an account with IG, you open an offshore account with IG specifically, that then gives you the ability to trade offshore markets, including options. And that we include S&P 500, DAX options, stock there's a whole world of options out there that you can trade in the developed world beyond South Africa's borders.
Just one last point. Are options in a way safer to trade than shorts or calls? So because you talk about the premium, there's an upfront cost always in trading these particular derivative products.
Yeah, I won't say they're safer. It depends on how you use them. If you are written on an option, effectively you can have open-ended risk, particularly if you're written on a call option, for example. So I won't go out and say that it's safer. I think it's like any derivative instrument. Somebody once said to me that it's like a kitchen knife. It's very useful in the right hands, but it's very dangerous in the wrong hands. So as long as you understand options, you know how they work, you can use them to be relatively safe and to create fairly safe strategies. But I think it's important to understand what you're dealing with, because they're not without their risks.
Yeah. And then just to end off with Garth, and obviously this show tonight will be repeated throughout the week. It'll also be on your website and on BDTV's website. Yeah. You've got a course dates, just to remind people, coming up in August.
Yeah, so the 19th of August, I'm doing a high probability trading course in Joburg. So anyone that would like to attend that, please email me on garth@traderscorner.co.za.
Right, that's where we leave it. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.